This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
Starting in January, we will be purchasing $75 billion of securities a month, reducing purchases of treasuries and mortgage-backed securities by $5 billion each.
Off to the races. Stocks zoom to record highs on news. The Fed thinks the economy is healthy enough for it to scale back its stimulus, but not strong enough to raise interest rates, perhaps for years.
Budget deal. Congress gives final approval to a government spending plan without any drama. Will the agreement help the economy continue its recovery?
And Rate Watch. Could today's decision by the central bank cause mortgage rates to spike, making it more expensive to buy a house and throwing a wrench in the economic turnaround? All that and more tonight on Nightly Business Report for Wednesday, December 18th.
Good evening, everyone. All those months of taper talk are done. The Federal Reserve said today it'll begin winding down its landmark stimulus program, a process Wall Street dubbed the taper. Starting in January, the central bank will cut back on its huge bond purchases by $10 billion a month. Why now? Speaking at his last press conference as Fed Chairman, Ben Bernanke said the economy is healthier and the job market is making progress. So this marks the beginning of the end of the Fed's historic easy money programs that were launched in 2008 to stabilize the economy during the debilitating financial crisis. The reaction on Wall Street was surprisingly positive. Stocks skyrocketed and the Dow and the S&P 500 hit new record highs. Here are the numbers. The blue chip Dow soared almost 300 points, rebounding from a 60-point loss and closing well above the 16,000 level. The Nasdaq jumped 46 and the S&P surged almost 30 points. Over in the bond market, prices on the 10-year Treasury fell and its yield rose to 2.89%.
We have two reports tonight on the Fed's big decision, one on the massive record-setting reaction in the stock market. Bob Pisani has that story. But we begin with Steve Leisman in Washington tonight on what the Fed did, why, and what Chairman Ben Bernanke said about it at his last press conference as central bank chief.
Outgoing Federal Reserve Chairman Ben Bernanke, an historic move, engineering a $10 billion reduction in quantitative easing or the purchase of assets by the Federal Reserve to take effect next month. It is the last press conference for Federal Reserve Chairman Ben Bernanke and his second to last meeting. And he explained why the Fed felt comfortable reducing the amount of quantitative easing in the economy right now.
Our modest reduction in the pace of asset purchases reflects the committee's belief that progress towards its economic objectives will be sustained. If the incoming data broadly support the committee's outlook for employment and inflation, we will likely reduce the pace of securities purchases in further measured steps at future meetings.
Bernanke suggested that the Fed would reduce the $85 billion in monthly QE in measured increments. It sounded like about $10 billion a month reduction, depending upon the economy. He said the course of reductions is data dependent. But he also said that when the Fed hits the 6.5% unemployment threshold, at which the Fed said it would raise rates, says, no, that's not going to happen anymore. The Fed giving substantial guidance that the Fed would remain on hold once they hit the 6.5% unemployment rate.
We couldn't put it in terms of another unemployment rate level specifically. So I expect there will be some time past the 6.5% before all of the other variables that we're looking at will line up in a way that will give us confidence that the labor market is strong enough to withstand the beginning of increases in rates.
Bernanke's last meeting is in January, and Fed Chair nominee Janet Yellen is supposed to be confirmed by the Senate this week as his replacement. Bernanke was asked if Yellen supports the program, and he said that she fully does. So policy is expected to continue to be pretty much the same under Janet Yellen as it was under Fed Chairman Ben Bernanke. For Nightly Business Report, I'm Steve Leisman.
The markets had been calm going into the Fed statement, indicating that many in the trading community were expecting Mr. Bernanke to find a way to begin tapering their bond purchases either this month or early next year. But they were also expecting him to calm fears that the Fed would begin raising interest rates anytime soon. He delivered on both counts. After a brief drop, stocks rallied, with the Dow Jones Industrial Average closing at the highs for the day, up almost 300 points. It was an historic closing high for the Dow Industrials, for the S&P 500, and it was a 13-year high for the NASDAQ. Yields on the 10-year Treasury bond initially vacillated wildly, first rising, then dropping, but ending the day not far from where it was prior to the Fed announcement. At the end, it was a very tame reaction in the bond market. As for volatility, the VIX, or the fear index, which is a measure of how much protection traders are seeking against market declines, went down, and it went down dramatically, about 15%. That is a very large drop, indicating that Bernanke is managing expectations in a way that's not causing traders to run out and to panic. The bottom line, this was an almost perfectly crafted statement that clearly said, first, low rates were going to be around for a very long time, and second, clearly said that there is no preset course for this taper program. So if the economic data worsened, for example, the Fed could stop the taper program or even reverse it. The Fed threaded this needle about as well as could be expected. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
We turn now to Mohamed El-Erian for his perspective on today's Fed decision. He's the CEO and co-chief investment officer of PIMCO, the world's largest bond fund. And Mohamed, nice to have you on the program tonight. So I know that you think that the Fed did the right thing today. So tell us why, and what does this mean now for consumers, investors, and most importantly for businesses?
So it means the most for investors. Mr. Bernanke gave investors a big Christmas present, and it has three parts to it. First, he removed the uncertainty of when the Fed will taper and how they will taper. In fact, in his press conference, he even gave us a roadmap for the next 12 months. Second, they compensated what they've taken away with a lot. In particular, they told us that interest rates will remain low for a long time. And thirdly, they upgraded their economic projections. So put all that together, and the markets loved it. So for investors, it's great. For businesses, it's quite good because it increases the wealth effect, and therefore households are better off. But for the average person, and particularly for the unemployed person, it is not clear whether this will materially influence their outlook.
You know, Mohamed, Mr. Bernanke was asked today, and it was a question that he didn't really seem to have a particularly adroit answer to, and that is, why hasn't quantitative easing or the stimulus program created more jobs than it has, or has it at all done that? What do you say?
So I think what it has is avoided something much worse. So I'm with him when he says the counterfactual would have been much worse. I'm also with him when he says that we've dealt with a lot of unexpected things, from the European crisis to what's been happening on Capitol Hill. But fundamentally, it is not a perfect instrument. If you want to get very wonkish, it acts to what's called the asset channel. It's about making you feel better so that you go out and spend more, and then businesses invest more. So it's a very indirect way of stimulating the economy. A much better way would be on public investment, removing long-term uncertainty, doing all this other stuff. Unfortunately, the Fed is the only policy-making entity in play, and therefore they are using imperfect policy, and they're getting imperfect results.
One thing that we kept hearing today from Chairman Bernanke is that this promise, this reassurance that interest rates will stay exceptionally low. And we know that the stock market has rallied on these low interest rates. So can we expect that through 2014? And does this change your approach to investing in stocks or bonds?
So clearly what they want to do is they want to maintain control of the short end of the yield curve. And why is that important? Because of the mortgage rate. So they don't want to shock the housing market because it's such a critical element of the recovery. So they are using aggressive forward policy guidance to try and convince people that short-term interest rates are going to remain stable. And today they largely succeeded on the short end. It's amazing that we had 300 points on the Dow, and yet the bond market was very well behaved. Now, in terms of what it means, you've heard us say this over and over again, Susie. Bill Gross has said it, I've said it. Be careful of where you invest on the yield curve. do not go out 30 years. Do not go out 20 years. That's dangerous territory. Stay focused and stay concentrated at the short end of the curve. That's where the value is. That's where the relative safety is.
All right. Lots of great information. Thank you so much, Mohammed. Hope you have a happy holiday.
You too.
Mohammed El-Arian, CEO and Co-Chief Investment Officer at PIMCO.
At his press conference today, Ben Bernanke said he was pleased Congress has reached a federal budget deal covering the next 2 years, and he likes the way it looks.
Relative to where we were in September and October, it certainly is nice that there's been a bipartisan deal. It's also, at least directionally, what I have recommended in testimony, which is that it eases a bit the fiscal restraint in the next couple of years, a period where the economy needs help to finish the recovery.
And tonight, that deal is a done deal after the Senate passed it late this afternoon. John Harwood joins us from Washington with more on today's vote and what it means. Were there any surprises, John, in the vote?
No, all the Democrats voted, 55 of them in favor. You had 3 fewer Republicans voting yes than voted to end debate earlier in the week. So it was a 64-36 vote. But this is something that both parties wanted to, and both parties' leaderships, even though Mitch McConnell voted against the deal, both parties' leaderships wanted this to happen for the reason that you heard Ben Bernanke express. It's not often that Washington these days gets a chance to please anybody, but they know that markets wanted this. They know that the country wanted this after all the turbulence this fall with the shutdown.
All right, so now that they're all getting along with each other in Washington, will that carry over into 2014, John?
Possibly to a limited extent, Susie. I do think that we can expect there will not be a shutdown when the government runs out of money in January, that they will extend government funding along the lines outlined by this deal. And I do think that even though some Republicans have said, yes, we're going to make some demands for the debt limit, I don't think they're going to push that to the brink so that we are going to have a smooth process on the debt limit. Question is, can we get anything bigger than that? Can we get immigration reform? Can we get a grand bargain? That is by far from clear, and I think is actually unlikely.
So if you've got a 2-year deal on the federal budget, then if the debt limit debate becomes cantankerous, what would the GOP be looking for in particular to let the administration raise the debt limit?
Well, you certainly could have them return to some of the issues of Obamacare that they've have loved to talk about during 2013, want to talk about in 2014 while they're trying to retake the Senate, hold the House. You could have them hold out for things like the Keystone Pipeline, which is something that has been an issue for Republicans. They've used that as a job issue, pitting that against Democratic environmentalism. Those are examples. But again, I don't think they're willing to take that to the max. The Republican Party was wounded badly by the shutdown in the fall. I don't think they want to repeat the same kind of experience in 2014.
A conversation to be continued, John. Thank you so much. John Harwood reporting from Washington. More now on how the Fed's decision to taper could impact Treasury yields and mortgage rates. Many home buyers and sellers are worried that those rates will rise in 2014, making home ownership more costly. Diana Olick reports.
At Apex Home Loans in Rockville, Maryland, will they taper? Lender Craig Strent watched today's Fed announcement with some trepidation, worried mortgage rates might spike.
I was relieved by how the markets reacted so far and that we didn't see a sharp rise in interest rates as a result of the Fed telling us that they're going to start tapering. That certainly could have happened. The
moderate pullback in both Treasury and mortgage bond purchasing did not push rates dramatically higher. The average rate on the 30-year fix has been sitting at 4.57% since the middle of last week. But concern over the Fed's potential move today may have been behind a sharp drop in weekly mortgage applications, down 5.5% to the lowest level in a dozen years.
Mortgage interest rates generally hate the idea of uncertainty, and so uncertainty is not a good thing. And so this definitely brings some certainty in terms of the Fed kind of showing their cards as far as the direction of rates.
But this is not the end for rate moves. The Federal Reserve is just beginning its pullback, and this week the regulator for Fannie Mae and Freddie Mac announced they would raise dramatically the fees they charge to lenders for loans with medium credit quality. Those fees will be passed on directly to borrowers.
Of the two announcements in the last 24 hours, by far the bigger of the two announcements was by Fannie Mae, particularly if you're a first-time home buyer who's looking at putting, less than 20% down. you could see mortgage rates rise, by as much as 0.4%.
While it may not sound like a lot, combine that with fast rising home prices and lackluster wage growth, and buyers, especially first-time buyers, will continue to struggle even to make the necessary down payment.
I think absolutely the rate increases will be painful.
Just not as painful as they could have been had the Fed made a bigger move in beginning its bond buying retreat. For Nightly Business Report, I'm Diana Olick in Washington.
Still ahead, Oracle was a darling of Wall Street until it hit a rough patch. As the company reports earnings, does it have a plan now to get back on track? Guilty on all 5 charges. That's the jury verdict in the insider trading case against money manager Michael Steinberg of SAC Capital, the hedge fund company run by the embattled financier Stephen A. Cohen. Steinberg faces up to 85 years in prison. He appeared to faint briefly as the jury filed into the room to announce its verdict. The former portfolio manager is the first of 8 criminally charged SAC employees to face trial for insider trading in the shares of several technology companies. 6 colleagues have already pleaded guilty, and one more defendant goes on trial in January. The verdict brings to 76 without a loss the number of successful insider trading prosecutions brought by the U.S. attorney in Manhattan since 2009. And earnings after the bell from the software giant Oracle, which reported a 2 cents a share beat and revenues that rose 2%, topping $9 billion. But profit last quarter was 1% lower on a slight drop in new software sales and subscriptions. Oracle is a company in transition, playing catch-up in offerings like cloud computing, something that has weighed on its revenue and its troubling outlook for the next year. Josh Lipton now with more.
Larry Ellison built Oracle into a powerhouse in Silicon Valley, a company generating billions in revenue with 120,000 employees and 400,000 customers. Corporations around the world use its software to help manage their businesses, everything from human resources to accounting. Along the way, Ellison also built himself a fortune. Forbes pegs his net worth at $41 billion. But in recent years, the technology landscape has changed dramatically, and the software giant's future isn't as clear. Oracle is dealing with a weak tech spending environment, which is one reason its executives have offered cautious guidance in the past. But there are also issues specific to Oracle. Rivals like Salesforce and Workday are attacking Oracle from the cloud, meaning they offer web-based software sold as subscriptions rather than licenses. IT departments are fans of the cloud because it can help them save costs and streamline operations. Analysts at Morgan Stanley say their survey work shows 38% of Oracle's customers are already using Salesforce. That's way up from just a year ago.
There's a lot of things going on in the software sector.
Barbara Coffey, an equity analyst at S&P Capital IQ, says Oracle missed the cloud trend, which has weighed on its stock, now on track for its smallest yearly gain since at least 1987.
The fact that they are sort of in catch-up mode has been the damper on the stock price as they watch others seeing greater growth from this new business model.
And we worked again and reworked.
Oracle is fighting back. Analysts say the company's new database designed for the cloud, announced in July, could see growth pick up next year. And despite the issues Oracle is facing, Coffey still thinks the stock is attractively valued. Investors used to think of Oracle as a cornerstone investment. The question is whether Larry Ellison can convince them it still is. Josh Lipton, Nightly Business Report, Silicon Valley.
Ford shares shifted down today after the automaker predicted a bumpy road ahead, and that's where we begin tonight's market focus. The company said the cost of launching a record number of new vehicles will reduce profits next year, which could fall by as much as $1.5 billion. The forecast caught investors off guard, sending shares 6% lower to $15.65, its worst one-day drop in 2 years. General Electric says it expects a double-digit profit growth in its industrial unit next year. The company's been shedding units that don't fit its new focus on manufacturing. So it now expects profits in aviation, healthcare, and other areas of its businesses to rise at least 10% next year. GE said it also plans to continue aggressive investments in manufacturing in 2014. Shares rose more than 1% to $27.41. Well, some key management changes at Boeing today. The company promoted the head of defense to the post of chief operating officer and named 2 other executives vice chairman. The moves might be part of Boeing's CEO succession plan since chief executive Jim McNerney retires next year. The stock fell slightly to $135.49. FedEx reported an earnings miss and blamed it on a drop in revenue in its biggest unit, express delivery. But despite the weaker than expected numbers, the company forecasted a strong holiday season and outlook for 2014. Shares were up a fraction to $139.72.
General Mills reported a second quarter profit that lagged estimates. The packaged food company saw sales slide in part because this year's late Thanksgiving meant the quarter for the company ended before the holiday. Increased commodity costs and unfavorable currency changes didn't help the Cheerios cereal maker either. Shares, however, were up slightly, $49.73 the close. Harland Clark, a bank check printer, said it would buy the public company Velasys Communications for $1.8 billion. Velasys prints marketing products like newspaper inserts and coupons. The Harland company said the deal would create a company now with more than $3 billion in combined revenue, and that sent shares of Velasys way up 22% to $34.60. And shares of AMC Entertainment rose in their first day of trading. The theater operator raised more than $330 million in its market debut. The CEO said the company's success is in its business model.
Not just adding more theaters, but making the theaters that are already in all of these communities a little better. We find that resonates with our guests. People like it. They come more often. When they come, they spend more money, and makes for a good business model.
And that stock ended the day at $18.90, up 5%.
Another delay for the healthcare.gov insurance marketplace, but this one may help Americans who are still shopping and figuring out how to pay for a plan. The health insurance industry says consumers who choose a plan by the Monday, December 23rd deadline now have until January 10th to pay their first month's premium for coverage to take effect on January 1st. That trumps the New Year's Eve deadline set by the government. And still ahead on the program, find out how much money the boom in American natural gas production could save you. That's next. Dow Jones is reporting tonight that Target was hit by a credit card breach over Black Friday weekend. The theft happened in stores, not online. The breach may be tied to malware at card swipe devices, and according to this report, it was extensive.
Well, if you like peace and quiet when you fly, Delta Airlines may be the carrier for you. The airline CEO said that no matter what the FAA decides about lifting its ban on in-flight cell phone calls, Delta will not allow any onboard calls on any of its flights. So there.
It's been cold and snowy, but the official start of winter is this Saturday. And despite forecasts of a colder than normal season, there is some good news for the millions of Americans who heat their homes using natural gas. There's a lot of it, and prices keep falling. Sharon Epperson explains.
There's a revolution brewing in America's heartland, and American consumers have been big winners, especially the ones who heat their houses with natural gas, or use electricity made with natural gas, or even use detergents and plastics that are made from gas products. The benefits may not have been readily apparent, yet economists say they're certainly significant.
It's not like you can go to a store and say, aha, the price of that's lower because of the lower natural gas prices, but they are, and that feeds through. So it's not something that's obvious to the eye, but it is clearly adding up for most people's pocketbooks.
The ramp up in shale gas production over the last several years has contributed to a more than 60% slide in natural gas futures since 2008. A new study by consulting firm BCG finds lower prices are benefiting consumers and the economy in significant annual savings.
Over the next 5 years, we expect that number to grow from somewhere between $400 to $700 to $1,200 savings because of the natural gas revolution. This will have a big impact on our economy because it frees up a lot of discretionary spending.
But while the slide in natural gas prices from the shale boom has been a big plus to the economy, some say future benefits to consumers may be somewhat overstated.
I don't think going forward we're going to see natural gas prices fall much further. So the plus for the economy, it's significant, but a lot of it's already in the economy already.
Natural gas prices have been on the rise recently and are expected to continue to climb into the new year, which may stall consumer savings for a while. For Nightly Business Report, I'm Sharon Epperson.
Finally tonight, there were two lucky winners in last night's Mega Millions lottery drawing. The winning tickets, one sold in Atlanta, the other in San Jose, will split a jackpot that ballooned to $648 million. If you take out the annuity fees and do the math, that means that the two mega winners will each get about $173 million. I went and bought a ticket right after the program last night.
Since you're here, you obviously
didn't win.
Get it. Not
Didn't
anything.
Win. Keep trying.
All right. That's Nightly Business Report for tonight. I'm Susie Garrett. Thanks for joining us.
And thanks from me as well. I'm Tyler Matheson. Have a great evening, everybody. We'll hope to see you right back here tomorrow night.
Nightly Business Report has been brought to you in part by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
I'm Susie Garrett with a Nightly Business Report news brief. The Federal Reserve will begin winding down its landmark stimulus program in January, cutting back its bond purchases by $10 billion a month. At his last press conference as Fed Chairman, Ben Bernanke said the time is right because the economy is healthier and the job market is making progress. The reaction on Wall Street was surprisingly positive. Stocks skyrocketed with the Dow and S&P 500 hitting new record highs. The blue chip Dow stock soared almost 300 points, rebounding from a 60-point loss and closing well above the 16,000 level. The Nasdaq jumped 46 and the S&P surged almost 30 points. And in Washington, a done deal. The Senate passed that 2-year federal budget proposal. Be sure to tune into Nightly Business Report right here on your public television station.